Oil is hovering near $110 a barrel right now. Major US benchmarks like the Dow Jones and NASDAQ have officially dropped more than 10% from their recent highs, landing them in correction territory. And the VIX, Wall Street's ultimate fear gauge, just surged past 31, showing us a market that is deeply unsettled. Let us start with the bearish trends weighing down the global economy. The market is currently dealing with a massive structural shift. The Federal Reserve is effectively trapped between an inflation floor and a growth ceiling. Earlier this year, investors expected interest rates to drop, but new projections show we might only see one or two small cuts later in the year. Some major banks are even pushing their first cut forecast back to September. Why? Because while the economy slows down, inflation in the energy and services sectors refuses to drop to the Fed's 2% target. Fed Chair Jerome Powell is speaking this Monday at Harvard University. If Powell signals that surging oil prices are making inflation worse, the market expects him to keep rates higher for longer. This is bad news for the AI bull market. Tech giants like Nvidia and Microsoft rely on debt to fuel their massive growth, and high borrowing costs could quickly dry up that funding. If you want to stay ahead of these massive market shifts and protect your portfolio, hit that subscribe button right now. We bring you the real, data-backed trends every single week so you never trade blind. Adding to the bearish outlook is the US labor market. We are looking at a job market that is stalling out. Back in February, the economy shockingly lost 92,000 jobs. For March, economists only expect a small bounce back of about 48,000 to 60,000 jobs. Even worse, a new rule starting this month means non-US citizens can no longer get Small Business Administration loans. Because immigrants create a huge portion of new jobs in states like California, this policy change could slow down hiring even more in the coming months. But here is the real danger for traders this week. The critical March jobs report drops on Friday, April 3rd. That happens to be Good Friday, meaning the US equity markets are totally closed. Traders will be stuck in a data vacuum. You will not be able to adjust your stock positions until the opening bell the following Monday, which could create massive, unpredictable price swings. Now, let us pivot to the bullish side of the market, because money is still flowing into very specific sectors. The ongoing military conflict in the Middle East, known as Operation Epic Fury, has totally transformed the energy and defense industries. Defense contractors are seeing a massive structural upgrade. Companies like Lockheed Martin and Northrop Grumman have recently hit 52-week highs. The US government is allocating tens of billions of dollars to boost munitions stockpiles and improve supply chains. This is not just a quick bump. Analysts say we are moving away from boom and bust cycles into multi-year procurement contracts. For example, the defense budget includes $780 million just for long-range anti-ship missiles. Energy stocks are also flashing green. The energy sector was the only one out of 11 broad S&P 500 sectors to go up during the recent market drop, gaining 1.9%. The conflict is threatening the Strait of Hormuz, a critical path for 1/5 of the world's daily oil supply. Because of this risk, a massive war premium is currently baked into crude prices. If diplomatic efforts fail, analysts warn oil could jump another $10 to $20 per barrel. Investors are seeking safety in energy ETFs and companies like Chevron that benefit from higher crude prices. So, what are our historical predictions for a setup like this? Historically, whenever energy prices spike rapidly while central banks keep interest rates high, the average consumer gets squeezed tight. High energy costs act as a hidden tax on the consumer, driving broad selling in the stock market. We are already seeing consumer sentiment drop to a low 53.3. When consumer confidence falls, retail companies usually feel the pain next. Here is your safe takeaway for the week. The broader market is facing a serious stress test, and the risk of a US recession in the next 6 to 12 months has climbed to 40%. Because the market is closed this Friday during a major data release, consider managing your risk and adjusting your positions by Thursday afternoon. Look toward defensive plays like defense and energy sectors, which are currently surviving the geopolitical shocks. This information was compiled from various sources across the internet and is not intended as financial advice.